Mish Schneider, Director, Trading Education and Research at MarketGauge.com, and Dory Wiley, President, CEO, Commerce Street Holdings, both joining us now for a great discussion on what we've been seeing in the markets, earnings season, and some sectors that may be more attractive than others. Mish, we'll start with you. I'd love to hear your overall market outlook. I know you think consumer staples appear to be an attractive group right now. How does that fit in with what you're seeing in the market, and why should investors consider consumer staples at this time?
Well, as we know, we're in an inflationary period, particularly with a lot of the consumer staples that we need every day, like food, for example. Or I was talking to somebody who has an infant, said the cost of diapers, because of that supply chain disruption as part of that, has skyrocketed. So what's interesting about consumer staples is that typically they're the things that are non-cyclicals. People buy regardless of what the economy is doing. And right now, even though we're looking at a slowdown in the economy overall, we're looking at the fact that inflation is rising, which could mean a stagflation. So with consumer staples, you still have to be careful, but you want to look at household goods and food and personal hygiene, alcohol, tobacco, and you want to assess them like you would assess any other stock. What makes them attractive to a lot of people in harder times is that they pay dividends, but of course the dividends could go away if a company's profit line really starts to sink and things get worse than what we would assume is just a normal correction. So just to kind of sum up what I just said, really what I'm saying is that consumer staples typically are good hedges on market corrections because people need these goods. But we're in a little bit of a different situation here with inflation, which could actually affect the bottom line cost to some of these companies, like, for example, a General Mills.
Yeah, and let's see if they transfer some of the higher prices over to the consumer. Dory, your thoughts on what we're seeing in the market and maybe about consumer staples or any other sector that you're watching closely as people are trying to navigate where to put their money to work?
Well, hello, Nicole. And I agree with Michelle's sentiment. It's a nice inflation hedge. It's also a nice hedge against a market that's likely to trade sideways throughout the year with upward inflation and pressure, and you know, this 3-point-some-odd trillion package passes. You know, that's going to put some pressure on the economy as well. I'm not even sure we need that. But getting back to consumer staples, you know, there's some just basic opportunity here. I mean, if you don't want to do any work and you pick the Vanguard ETF, BDC, it yields 223 versus an S&P at 1.4%. So I get a higher yield with lower volatility and risk. Why wouldn't I do that? There's some really great plays in here, too, with some really great themes. You look at Target and its growth rate, it's doing really well, a little bit lower yield, 1.43%, but it's growing and the stock is going. You want to take a flyer at Best Beer, SAM. That's a nice play. It's got a 65% revenue growth rate. That's a takeout target. And it's got a 27 forward PE, but its PEG ratio, price to earnings growth, is only 0.9, which is really low for consumer staple. Bunch Holdings, 275 yield, forward PE of 10. Kroger, 219, forward PE of 12.5. Those are great. And if you really don't like a lot of risk, I love the word dividend aristocrats. You know, those are companies that have paid dividends, increased them, and never missed for 25 consecutive plus years. There are 13 of those in the S&P 500 in the consumer staple sector. 2 of them I actually think stand out, even though they're all great long-term plays. Archer Daniels Midland at 2.5% yield and 13.2 forward PE. I think is just a fantastic buy. And an even better one is Walgreens, 9.28 forward PE and a 1.95 PEG, 3.95 yield.
Wow, that is pretty great. Mish, you want to add on to that a little bit?
Well, Dory certainly mentioned all of the hot stocks, and I agree. There are a couple of others that are consumer staples but don't necessarily pay dividends that could be interesting, like one would be Monster Beverage. But one I wanted to add to what Dory said is that XLP, which is an ETF for consumer staples, year to year is up about 20.7%. Where you look at the Russell 1000 is up 40%. So the whole space has actually underperformed. So it will be interesting to see as we go ahead, especially I agree with Dory when he says we could get into a stagnation, whether or not these type of stocks, these consumer staple stocks with their dividends that pay will actually start to take some leadership. And I would certainly keep my eye on that sector.
Right, absolutely. And Dory, as we look at what's going on here with earnings season, how important is this earnings season? So far, we've heard from a lot of the banks, right, and doing better on earnings per share, but some of that is from the reserves being released, right? And so they have more money to put to work because they had put that money aside just in case. But some concerns about net interest income. We're hearing from some of the airlines that are showing some forms of profitability, but still they've had so much government help and have taken on so much debt. So what are you thinking about earnings season? Is it very important to watch what's going on now?
Well, it's always important. The question is what's priced into the market, right? And you bring up banks, obviously something we watch very closely here at Commerce Street. And banks have been trading about 65 to 75% of the forward PE of the S&P 500. And that's just because the market doesn't believe them. I hadn't believed them since 2008. But the banks are real. They're doing very well. Yes, they over-reserved. They were very conservative. Their stocks crashed in the COVID. They bounced back. They haven't had the credit problems. They've had record high levels of capital. But this is not a temporary thing. The banks are doing very well going forward. They got plenty of liquidity. They're lending very conservatively. They are the plumbing and wiring for the economy, and that tends to support all the other sectors. So it's very, very key to watch what these banks are doing, and they're doing very great as expected. And I continue to expect them to do well, and that will filter through the economy. But I do think the stock market will continue to trade sideways probably through the rest of the year because questions of the Fed, the governance, the inflation, the raising rates, and the fact that the market as a whole is a high valuation.
Okay. Yeah. Thank you both, Mies Schneider and Dory Wiley. It's always great to have you on the show. Particularly, I just heard you, Dory, talking about some sideways action that may be likely going forward. I mean, I think people expect some volatility, especially during this time where we have questions on inflation and what the Fed may or may not do. You'll have to come back, both of you, and we'll have to continue our conversation. Mies Schneider, Director, Trading Education and Research, MarketGauge.com, and Dory Wiley, President, CEO, Commerce Street Holdings. Thank you both. Midday Trade.